Over the next few minutes, I'm going to prove to you that by managing your own portfolio, you can outperform nearly all money management professionals, even in these new and uncertain times. And at the end of this video, I'll let you in on the little secret that the best managers out there use when the markets get volatile and choppy to continue to grind out consistently good returns. So let's get started. There are more investors who self-manage their portfolios than ever before. We've all seen Fidelity and Vanguard grow by leaps and bounds over the years. And the bottom line is that the number of self-managed investors has grown and continues to grow for a couple of reasons. First, there are more set it and forget it accounts than ever before. And what I mean by that is most of us have a 401k type account, someplace we invest money that sits there largely untouched until we retire. And second, our own personal experience with those kinds of self-managed accounts is that they have performed just as well as a professionally managed account. And that's not a mirage. Those accounts truly have performed just as well as most professionally managed accounts. You see, money managers follow the herd and invest in what we might call a broad market strategy. They put your money in a mix of large cap, small cap, mid cap, and international investments, and they leave it alone so that they don't miss out on the best days of the market. And money managers do that because they have a problem. They have to invest wisely, and they have to convince people that they're investing wisely. And it's too hard to convince the investing masses that a wild, never-before-heard-of strategy is a better bet than the tried and true strategies that all the other managers vying for your dollars are using. There's safety in numbers. And that's why professional money managers, by and large, all invest in strategies that mirror the S&P 500. But isn't that exactly what most of the rest of us self-managed investors do? We invest in broad market index funds, some large cap, small cap, mid cap, and international funds, that we then just leave alone so that we don't miss the best days of the market. Sound familiar? So if we're all doing the same thing, it makes sense that professional money managers wouldn't do any better than the typical self-managed, or what I would call DIY investor. And as it turns out, most DIY accounts do better than a professional money manager for one very simple reason. Fees. Self-managed investors don't have to pay fees to a professional manager, and that fee savings compounds over time and ends up making a big difference. Warren Buffett famously bet all takers that the S&P 500 over a 10-year period would outperform professional money managers. He offered any money manager who could prove that they could outperform the S&P 500 over 10 years $1 million. And he won that bet. There wasn't a single money manager who was able to collect. Check out this headline from CNBC in March of 2019. Active fund managers trail the S&P 500 for the 9th year in a row in triumph for indexing. But wait, wasn't that 10-year period during a bull market? What about when the market goes down? Isn't that when the manager shines? I mean, that's what they would like you to believe, right? Well, money managers lose just as much as others during market corrections and bear markets. That CNBC article went on to note that the figures highlight that heightened market volatility does not necessarily result in better relative performance for active, or as we would call it, professionally managed investing. What's different about 2018 was the fourth quarter volatility. Active managers claimed that they would outperform during volatility, and it didn't happen. Look, the bottom line is that it doesn't make sense to pay more since you don't get more. But things are different now. The markets have been pretty erratic lately. It seems like we're entering uncharted waters where it might be prudent to get a professional's advice. Well, it's true that the market has been very erratic and maybe even a little bit scary lately. But it's not true that we haven't seen this before. In fact, if you look back over the past 100 years of the Dow Jones Industrial, there have been long stretches of growth, followed by long stretches of erratic returns, followed by long stretches of growth, followed by long stretches of erratic returns. And these stretches of growth last 10 plus years. and these stretches of erratic returns last 10 plus years. I mean, the truth is, nobody knows what the market's going to be like going forward. But if you had to guess, what would you think? Are we due for another 10 plus years of strong growth? Or could we be in for 10 plus years of erratic returns? There are actually managers that have seen these kinds of markets before and have successfully steered through them. They're the managers of large Ivy League university endowment funds. Some of these university endowments have been around for decades. They've been through not just the good, but also the erratic and the bad. The little secret that true professionals, the ones who manage university endowment funds, the little secret they have is to stick to a very specific, well thought out strategy that has gotten these big endowment funds through all of those previous erratic return periods we just looked at. But that strategy is not the buy and hold strategy that got all of us through the bull market of 2009 to 2019. And next time, I'll show you exactly why a buy and hold strategy doesn't always work. And I'll show you the strategy the best investors use to consistently grind out the best returns during erratic and volatile markets. I think you'll be surprised at how simple that strategy is. Until then.